good afternoon or good morning or good evening or just whatever time of day it is. It's sure good to have you on board. Alex and I have what I find some very compelling information to share with you. So uh, give us some look and thought through. I think it's going to be very helpful to you. Do you agree with me on that, Alex?
Absolutely. Let's go.
Let's get started. So what we're talking about when Alex and I choose a stock, or if you were to choose a stock, how do you pick a stock? And most often, Alex, I hear clients come in or prospects come in and they have an idea for a good stock that doesn't hold water. It's just me and you don't do any of it. They say, Apple's coming out with a new phone that we think it's a great buy. Buy that stock because of that, or some other reason they have. And so there's some fundamental basic things we look at that give us our starting spot. Now we have over 100 items to look at. So this isn't a full tutorial on how we do this, but I'm going to give you a high level view. Well, think about it. If you were looking to buy a stock today, you'd do better to think about it as buying a company. And if me and Alex were going to pool our money together and go buy a company, what financial factors would be of importance to us? And stop and think about it. Well, whatever company we're going to buy, Alex, I think sales are really important. Would you agree?
Absolutely.
And I want the kind of sales I like to have are not just high sales, but increasing sales with little downward volatility. So that's important to me. Another thing I think is important, Alex, I was in business, in the remodeling business years ago. I think profitability is important. So whatever they're selling, this company, I want to make sure they have a good profit ratio, good gross profit. Beyond that, I want to see what the earnings per share are. That's a number, Alex, that I would like to see start off small and get bigger over time. I may look at different types of earnings measurements. I may look at EBITDA as well. On the other side, their income after they sell their product is really important. And again, I'd like growing income. Another factor I think is really important if we're going to buy this company is I want to make sure that they're well run enough to where they're able to save money every year, that their free cash flow is high. And that's going to be the basic fundamentals for our discussion today. So let's take a look at one that I think is a good example that this company makes police supplies for policemen. And if you watch YouTube videos where the police are arresting people, you'll see this company listed. It's called Axon, and they make tasers and they make different supplies for policemen. But let's go to their income statements, Alex. And looking at it here, I see that their income in 2018 was $420 million. And you see it's growing, I guess every year it grew. It got bigger and bigger and bigger. The last 12 months, it's 2.2 billion. So to me, that's a promising number there. If I take a look at their gross margin, it's 60%. So that's a healthy growth margin. I go up a little down to the bottom here, and if I look at their earnings per share, back a few years ago, it was 52 cents, and it went down, 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 and then up the last 4 years. Now it's 800% more. So that's a good thing. Earnings before interest, taxes, depreciation, and amortization, another earnings measurement, has gone from 35.5 to 229. So this is a stock that I'm interested in looking at a little further. So I'm gonna go take a look at their cash flow, and I want to see what their net income is after expenses. And it was 29 million over here. It dropped. This is COVID, and then it's gone up really steady and strong since then. So that looks good. Now, their free cash flow, which is how much they're saving after all expenses, is really strong. From 52 million up to 176 last 12. So Alex and I would look at that and we said, this is promising. Now, granted, we have quite a few different metrics we're going to go through, but for our discussion day, for the sake of simplicity, I'm going to leave it to these few factors I think are broad enough to give you a good idea. Let's take a look at the balance sheet, see how their assets versus liabilities fare out. And if you take a look at it, their total assets are $6.2 billion and their liabilities are 3.4. And what that means is that they've got a $2.7 billion net worth. If they liquidated, there's $2.7 billion left over. And you see the equity has gone up substantially over the last few years. So the next thing Alex and I are going to do now, notice we don't start looking at price. We're not looking at the prices. I'm not concerned about the price of stock right now. I want to see how this engine's running. But now I'm going to take a look, get some more information on the price and the volatility of stock and what Alex and I can expect should we buy this stock. So we go over here and we see that this stock is considered a moderate stock. So it's not an aggressive stock. It's not a cautious stock. The estimated annualized return is anywhere from a -1 to a 25. But this important number, Alex, I really want to show our clients this number a lot. During a bear market, what is the estimated maximum drawdown or maximum loss? Here's why it's so important. Let's say me and you buy this, and a year from now, it's down 39%. We're in a bear market. And you look at the fundamentals on it, and you say, John, the sales are still good, the profits are real good, the income, the fundamentals still look very, very strong. The value of the company is still there. And you said, John, do you want to sell this? Do you want to hold on to it? Or do you want to buy more? And I think about that and say, well, what I want to do is I want to buy low and sell high. And this, to me, in a bad market, a bear market, one thing Alex and I are scrubbing, looking real hard to look at every bear market is there's going to be some jewels to pick up. So in this case, I would invest more. Now let's take a look at Axon here, the last 5 years. And it has made 704% in the last 5 years, and the market's made 90%. So that's a multiple market of about 800% more than the market. If we, in 5 years is what I'm looking at, Alex, because we have it takes 5 years for our stocks to go through the cycle. If I take a look at a 10-year history on this, now we're at 2,800% and the market's at 201. So this is a simplified version of what Alex and I do every day, all day long. And that's how we can have conviction when we buy something. We know it's good, not because of today's price action, but because of the fundamentals here. But Alex, I'd like to take a stock, another stock you look at that maybe the fundamentals aren't the same and show how that affects their price. Which one would you like to take a look at?
Let's take a look at a company called Intel. Everybody's probably heard of this. It's a semiconductor company. It used to be kind of the belle of the ball in the 90s and 2000s. And what's really interesting about this is in a sector that is growing substantially, just gangbusters with the AI wave, this company is just being run into the ground. And just like John said, regardless of the price, the fundamentals are just deteriorating at such a terrible pace that the stock price is just going to reflect that, right? So they're getting their market share eaten away at. They haven't really come out with any new products. There's no innovation. Probably people that work at the company are leaving. There's so many bad signs, but let's just, again, look under the hood so we can tell what's wrong with this company. There you go. So in peak revenue, looks like 2020 or 2021 has fallen almost by half. So their sales are just falling off a cliff. That's not something that you see in a company where the stock price continues to go up and appreciate. This is a big warning sign because they're just, the whole basis of profit is from sales. So if sales are going down, I doubt that the profits will be able to stay that high. Additionally, the margins, which is basically the profit that you take home from selling the products, has also dropped by about half. So they're not only selling less, they're making less per dollar that they sell on. So it's almost like a double strike. And, you know, a lot of these metrics that we look at, either just one of them isn't good to see negative numbers, but at the end of the day, earnings per share, when you're losing money, when you're actually, at a loss per shareholder, there's no way the stock price can continue to appreciate historically. That's just the biggest red flag that we see. So in my view, this is a broken company. And what you'll see is a lot of people who recognize Intel will say, "Oh, Intel's cheap. I should buy it." And they've, lost half the money of the last couple of years, or they're invested in a way where they're forced to buy this. So we see people that come in all the time. They have, 500 stocks or 600 stocks, and they go, "Why do you own this? This thing is just losing money for you." Well, I'm invested in the S&P 500. So this is part of the S&P 500. So I got to own a little bit of it. Well, that doesn't make sense, right? If you ran a basketball team and you had an injured player, sadly, you're going to take him off the team or trade him to another team. There's no reason to keep him on the bench and keep feeding him if he's going to lose points every game. So,
Alex, an interesting side note is on a daily basis, I'm doing an analysis on the prospective clients' portfolios. And on probably a weekly basis, I examine a mutual fund they have that happens to own Intel. They don't know they own it, but the mutual fund owns it. In other laggard stocks as well. Look at the happening with on the earnings before interest, tax, depreciation, amortization. That's 32 billion down to 1.12. Huge.
huge.
So take a look over here at their cash flow, see what's happening.
Negative. Bad sign.
Really bad. This is just no reason I can't conceive of buying a stock like this, but there are millions of people in our country that own this. And by the way, most of them own this within the confines of a mutual fund. They don't know what they're buying. So let's take a look at their cash flow here, the free cash flow, and discuss that a bit.
Essentially, it's gone negative since looked like 2018, 2020. And really, you can't do anything in a company without free cash flow. You can't pay a dividend. You can't buy back your shares. You can't pay down debt. You can't acquire other companies. You can't build new plant and equipment. You can't even really hire people or compete with talented people. So when you start having negative free cash flow, it's really a bad sign. You're handcuffed to what the company can even do. So what will happen is in certain cases like this and other companies that have come and gone is it gets so dissipated to a point where they start breaking up the company. They start selling off parts of it. They start looking for an acquirer, for someone to buy them out and just buy all their facilities and buy all their equipment. And that happens all the time. That's been happening for hundreds of years. It's just not a company or a stock you want to hold in any meaningful way in your portfolio because the writing's on the wall. It's been on the wall for 5 years now. So if you're still holding this thing, thinking it'll come back, I'm sorry to say, it's probably not going to happen.
And I would add also, Alex, that Intel is not an exception. We have a whole basket full of stocks that are performing poorly that people are still buying. Let's take a look at their assets and liabilities over here on the balance sheet and see how that's holding up. Big assets, $43 billion in assets, 192 billion. They're a big company. And liabilities are 86.
Increasing slightly, but yeah.
Yeah. So the shareholder equity remarkably has gone up the last few years while the value has gone down.
Yeah, and it really just tells you, these guys have been around for 30 plus years and they probably have a lot of factories and they have a lot of machines and they have a lot of intellectual property, but they're just not producing any revenue, earnings, or free cash flow with it. So at some point, the stock price will get so cheap, somebody will come in. I don't know if you've heard of like vulture capitalism, and they'll say, okay, you guys aren't making any money. I'll buy your fab equipment for X amount of dollars. Take this off your hands. And they'll just basically break this thing up. This happened a few times, even in the oil industry, also, a few times in the tech industry as well. But yeah, this is just a really good case study on a big company, an S&P 500 company that has just been dead money for 10 years. And everything is easier to see in hindsight, but this is not something that we would ever bought, in the recent past at all, just because the fundamentals just weren't there. It just wasn't performing enough on their fundamentals for it to even be considered a candidate for the portfolio.
And let's take a look at the last 5 years and see what that's looked like over here.
So while the market went up, almost 100%, 90%, this has lost 60%. So although the Intel is inside the S&P 500, you don't have to be blindly inside an index. No one's forcing you to buy the mutual fund that follows any index or any strategy. But if you just were to hold the companies that are profitable, low debt, well run, and solid momentum, which is a subset of the S&P 500, historically that selection alone has outperformed the S&P, over full market cycles. And we always like to use that. We always like to emphasize a full market cycle because a quarter is a quarter, a month's a month, anything can happen. Look what happened earlier this year. The market went down 18% in, a month, and everybody thought the world was going to end. Tariffs were going to kill the economy. Well, here we are, all-time highs. Tariffs didn't kill the economy. The companies that are making money still made money, and, we're back at all-time highs for a lot of them. So regardless of what Intel is showing, I mean, there's still plenty of opportunity in this market for stocks to go higher, especially with this AI boom. I think you're going to see, large opportunities in certain areas that are still waiting for rates to fall. And, it just seems like the news cycle has run out of steam with the pessimism. And so I don't think they can be negative about much more at this point.
So if you look at this chart here, it shows the last 10 years,
Mm-hmm.
Intel's lost 33% and the market's made 201. So what it means for our clients that are viewing this video is when you come in for your reviews, I'm going to be taking your portfolio and taking a number of the stocks that you own and showing you the fundamentals of why we bought that stock, what it's doing, how it's working out, how it's performed over the last 5 and 10 years, both in the value and the growth side. So we've got really good numbers over a period of time by being just real choosy about what we buy. So do this for me as you view this video. If you enjoy this type of video and would like more of it, send me a text or email, let the office know. I'll do more of these as well. We look forward to that. All right, gang, that's about it. Let me hear back from you on how you appreciate this. Have a great week. Take care.
Bye, guys.